Imagine receiving a consistent paycheck every month, regardless of whether you show up to work or what the headlines say. This is the power of dividend growth investing. While growth stocks offer the thrill of the chase, dividend index funds provide the foundation of financial independence. Today, we are breaking down the absolute best dividend funds for 2026, the vehicles that turn your capital into a reliable income machine. But before we break down the yields and the safety scores, make sure to hit that like button and subscribe for more deep dive market analysis. Ready to build your passive income fortress? Let's begin. We start our analysis with the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. This fund is a favorite among income-seeking investors for its unique focus on two critical factors: yield and stability. Currently trading around $50, the SPHD chart shows a remarkably resilient performance, maintaining an upward trend even during periods of broader market correction. The fund is designed to isolate the highest yielding stocks within the S&P 500 and then filter for the 50 stocks with the lowest historical volatility. This dual screen approach ensures that you aren't just chasing high yields into risky companies, but rather capturing income from the most stable blue chip corporations. For investors in 2026, SPHD represents a powerful defensive tool that provides a psychological floor during market turbulence while still delivering consistent quarterly returns. Its recent price action confirms its status as a reliable anchor for any income-focused portfolio looking to mitigate downside risk without sacrificing yield. Diving deeper into the SPHD strategy, one of its most attractive features is the distribution frequency. This ETF pays monthly dividends, which is a massive advantage for those relying on their investments for regular cash flow or for compounding their returns through reinvestment. The fund's methodology is incredibly disciplined. It limits each sector to a maximum of 25% across no more than 10 stocks, with individual stock weights capped at 3%. This strict diversification prevents the fund from becoming overly concentrated in a single industry, such as utilities or real estate, which are common traps for high yield seekers. By focusing on the intersection of high yield and low volatility, SPHD provides a smoother ride than the broader market. It is a professionally managed vehicle that automates the complex task of finding quality income, making it a cornerstone for those who prioritize predictability and monthly paychecks over speculative capital appreciation. Next, we look at the iShares Core High Dividend ETF, ticker HDV. Benchmarked to the Morningstar Dividend Yield Focus Index, HDV offers a concentrated portfolio of approximately 75 high-yielding U.S. stocks. What separates HDV from its peers is the rigorous screening for financial soundness. Before a stock can enter the fund, it must pass Morningstar's proprietary economic moat and distance to default filters, ensuring that the company has the financial strength to sustain and grow its payout. HDV typically overweights sectors known for reliability, including energy, consumer staples, and healthcare. This makes it an ideal core holding for investors who want broad exposure to the most stable income generators in the American economy. With its low expense ratio and focus on quality, HDV provides a high conviction approach to dividend investing, allowing you to own the highest quality cash cow businesses while avoiding the yield traps that often plague less disciplined dividend strategies. For those who value legacy and reliability above all else, the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL, is a premier choice. This fund only invests in S&P 500 members that have increased their dividends annually for at least 25 consecutive years. These are the elite of the corporate world. Companies that have proven they can grow their payouts through recessions, wars, and various economic crises. The index is equal weighted, meaning you aren't just betting on the largest tech giants, but rather gaining balanced exposure across all the aristocrats. NOBL is often viewed as a quality factor investment. The ability to raise a dividend for 25 years is a powerful signal of a strong business model and disciplined management. While its starting yield may be lower than SPHD or HDV, the long-term compounding power of these annual increases is what builds generational wealth. NOBL is the ultimate buy and hold vehicle for 2026. We turn now to what many consider the gold standard of dividend ETFs, the Schwab US Dividend Equity ETF, ticker SCHD. This fund tracks the Dow Jones US Dividend 100 Index and uses a sophisticated composite scoring system. It doesn't just look at yield, it screens for fundamental strength using four key metrics: cash flow to total debt, return on equity, dividend yield, and the 5-year dividend growth rate. This multi-layered approach ensures that you are owning the most profitable and financially healthy dividend payers in the market. SCHD has a remarkable track record of both dividend growth and capital appreciation, often outperforming the broader market during flat or down cycles. For investors in 2026, SCHD offers the perfect balance of current income and future growth. Its low cost and high quality holdings make it a nearly essential component of any diversified portfolio, providing a rare blend of stability, growth, and institutional grade risk management. For broad-based high-yield exposure, the Vanguard High Dividend Yield ETF, ticker VYM, is a staple. Benchmarked to the FTSE High Dividend Yield Index, VYM provides access to a massive market cap weighted portfolio that includes approximately 55% of the highest yielding stocks in the US market. Unlike more concentrated funds, VYM offers extremely broad diversification, holding hundreds of companies across every sector except real estate. This exclusion of REITs is a strategic move to maintain tax efficiency for many investors. VYM is prized for its ultra-low expense ratio, which is a hallmark of the Vanguard philosophy. By keeping costs at a bare minimum, VYM ensures that more of the market's total yield flows directly to the shareholder. For those who want a simple, effective, and broadly diversified way to capture the income-generating power of the U.S. equity market, VYM remains a top-tier choice for 2026, offering both reliability and the peace of mind that comes with the Vanguard name. On the opposite side of the yield spectrum is the Vanguard Dividend Appreciation ETF, ticker VIG. While VYM focuses on current yield, VIG focuses on dividend growth. It tracks the S&P US Dividend Growers Index, screening for companies that have increased their payouts for at least 10 consecutive years. Crucially, VIG excludes the top 25% of the highest yielding stocks in the index. This might seem counterintuitive, but it's designed to avoid companies with potentially distressed yields and ensure the highest possible portfolio quality. VIG is essentially a quality growth fund that pays a dividend. It is often less volatile than the broader market and provides excellent capital appreciation potential. For younger investors or those who don't need immediate income, VIG is a powerful tool for capturing the compounding power of companies that are committed to growing their payouts over time. It represents a more conservative, growth-oriented approach to the dividend space, prioritizing long-term value over short-term yield. The iShares Core Dividend Growth ETF, ticker DGRO, offers another compelling option for those seeking quality growth. DGRO targets companies with at least 5 consecutive years of dividend growth and a positive consensus earnings forecast. A key differentiator for DGRO is its strict payout ratio requirement. It must be less than 75%. This ensures that the companies in the fund aren't starving their own growth to pay a dividend. Rather, they are paying out of a position of strength and sustainable earnings. DGRO also strategically omits the top 10% of the highest yielding stocks to avoid yield traps and preserve overall tax efficiency. For investors in 2026, DGRO provides a well-balanced approach that combines steady income with significant potential for dividend growth. It is a highly efficient, low-cost core holding that captures the sweet spot of companies that are both rewarding shareholders and continuing to invest in their own future operations. It's a disciplined approach to sustainable income. Rounding out our fund picks is the Wisdom Tree US Quality Dividend Growth Fund, ticker DGRW. Unlike many funds that look primarily at historical data, DGRW uses a forward-looking methodology. It screens companies based on 3-year historical averages for return on equity, ROE, and return on assets ROA, as well as long-term earnings growth expectations. The portfolio is then weighted by the cash value of the dividends themselves. This focus on quality and growth potential makes DGRW a unique hybrid between a dividend fund and a core growth fund. It is designed to capture the performance of companies that are not only profitable today, but are positioned to be the leaders of tomorrow. In a market where quality is increasingly prized, DGRW's emphasis on high ROE businesses provides a level of fundamental security that is hard to match. It is an excellent choice for investors who want institutional grade quality and a portfolio that is built to thrive in a high growth environment while still providing a growing income stream. Before you invest in any dividend fund, it's critical to do the proper groundwork. The first step is to determine your overall asset allocation. How much of your total portfolio should be in dividend-paying stocks versus other assets like bonds or growth stocks? This decision depends on your age, risk tolerance, and income needs. Once your allocation is set, you can use major online brokerage platforms to screen and compare ETFs based on three primary factors: cost, holdings, and income characteristics. Look for funds with low expense ratios, as these fees eat into your compounding over time. Analyze the underlying holdings to ensure you aren't overexposed to a single sector. Finally, check the income characteristics. Is the yield sustainable, and does the fund have a history of growth? By following this disciplined process, you can select the dividend funds that best align with your personal financial goals and build a portfolio that is truly resilient for the long term. One area that often confuses dividend investors is yield measurement. There are three main ways to measure it, and each tells you something different. The 30-day SEC yield is the most apples to apples comparison. It looks at the fund's income over the past 30 days, net of expenses, and annualizes it. The 12-month trailing yield looks backward at what the fund actually paid out over the last year. While this reflects real cash received, it may not represent future earnings. Finally, there is the annualized distribution yield, which projects the most recent payment forward for a full year. This gives a quick estimate of current income, but assumes the payout stays constant, which isn't always the case. For 2026 investors, understanding these differences is key to accurately assessing your potential income. Don't rely on just one number. Look at all three to get a complete picture of a fund's income-generating power and the stability of its distributions. Accuracy in yield assessment is the first step toward reliable income planning. It's essential to remember that dividend yield alone is not a perfect indicator of future performance. In fact, a very high yield can sometimes be a warning sign of a yield trap, a company with a falling stock price and a payout that is unsustainable. Focusing exclusively on high-yield companies often leaves out the most explosive growth stories, such as those in big tech, which grow through price appreciation rather than dividends. To be a successful investor in 2026, you must construct a diversified portfolio that spans a broad range of underlying firms with different capital strategies. While dividend funds provide a great foundation of income and stability, they should be balanced with growth-oriented investments to ensure you aren't missing out on the broader market's upside. The goal is to maximize your total return, the combination of both dividends and price appreciation. By looking beyond the yield and focusing on the overall health of the businesses you own, you can build a more robust and profitable long-term portfolio. Why should you invest in dividend index funds? The benefits are clear and powerful. First, they provide a steady income stream for those seeking regular cash flow. Second, they offer instant diversification across many dividend-paying companies, which significantly reduces the risk associated with owning individual stocks. Third, these funds help identify value-oriented companies through high-yield dividend strategies, often leading you to higher quality firms with strong balance sheets. Dividend growth funds in particular focus on companies with consistent payout increases, a major signal of corporate quality and financial health. Finally, these funds typically have low fees and offer an easy passive way to gain exposure to income-generating stocks. For most investors, a dividend index fund is the most efficient vehicle for capturing the dual benefits of income and quality, allowing you to build wealth without the complexity of active management. It's a simple, proven way to let the most profitable companies in the world work for you. Every investment carries risk, and dividend index funds are no exception. One of the primary risks is dividend cuts, which can occur during market downturns or severe recessions. High yield funds may also include riskier or slower growing companies that are more vulnerable to economic shocks. Additionally, interest rate changes can significantly affect investor demand for dividend stocks. When rates rise, income seekers may move to bonds, potentially causing dividend stock prices to fall. It's also important to note that dividend index funds often underperform growth-oriented ETFs during aggressive bull markets led by tech giants. Finally, even qualified dividends can create some tax drag in taxable accounts, reducing your net return compared to non-dividend growth stocks. By understanding these risks, from sector concentration to interest rate sensitivity, you can better position your portfolio to withstand various market environments. Awareness of the downside is what allows you to stay disciplined and committed to your long-term income strategy. To maximize your dividend investing success, follow these 3 tips. First, check the distribution frequency. Some funds pay monthly, while others pay quarterly. Choose the one that best suits your income planning or reinvestment strategy. Second, prioritize tax-sheltered accounts, like a Roth IRA. In these accounts, your dividend income compounds most efficiently because distributions are not taxed immediately. This is especially critical for higher yield funds. Third, use a dividend reinvestment plan or DRIP if you don't need the immediate cash flow. A DRIP automatically uses your dividends to buy more shares, helping your wealth compound much faster and removing the temptation to time your reinvestments manually. These 3 simple steps, matching your frequency, maximizing your tax benefits, and automating your reinvestment, are the keys to unlocking the full wealth building potential of dividend index funds. It's about making small, disciplined decisions that lead to massive long-term results. Efficiency and automation are your best friends in the pursuit of financial freedom. The most important thing to remember is that dividend index funds are long-term investments. The stock market is naturally volatile in the short term, and dividend stocks are not immune to these swings. However, the longer you hold your index funds, the better performance you are likely to see. Longer holding periods allow more time for the power of compounding to work its magic, enabling your money to grow exponentially in the later years. Short-term market movements are often erratic both in direction and magnitude and are notoriously unreliable for successful investing. If you can ignore the daily noise and stay focused on the multi-year horizon, you will be in the best position to capture the true wealth-building potential of these funds. Dividend investing is a marathon, not a sprint. By committing to a long-term horizon, you are giving your capital the time it needs to generate consistent income and grow through every market cycle. Patience is the most valuable asset in an investor's toolkit. In conclusion, historical data shows that longer-term investment horizons have reliably trended upward, especially for dividend-paying blue-chip stocks. Furthermore, longer holding periods make your portfolio significantly more tax efficient. If you keep your dividend index funds for longer than the designated holding period, you'll be eligible for qualified dividends, which are taxed at a much lower capital gains rate. This simple tax advantage can save you thousands of dollars over the life of your investment. While short-term price movements are entirely normal and expected, a long-term focus has historically been the most successful strategy for building sustainable wealth. By combining the power of elite corporate earners with the benefits of low-cost index funds and long-term tax efficiency, you are building a financial engine that is designed to last. Stay focused on your long-term goals, trust the compounding process, and remember that time in the market is always more important than timing the market. Your future self will thank you for the discipline you show today. Building a dividend fortress for 2026 is about more than just picking the highest yield. It's about quality, discipline, and long-term compounding. We've covered the best funds from SPHD's monthly income to VIG's growth focus and the strategies you need to succeed. Which of these funds fits your 2026 goals? Are you prioritizing current income or future dividend growth? Share your thoughts in the comments below. If you found this deep dive valuable, don't forget to like, subscribe, and hit that notification bell for more institutional grade investing guides. Thanks for watching, and here's to your successful dividend journey.